In today's video, we are going to go over what a premium offset is, what a reduced paid up option is, and then also what an automatic premium loan option is. Automatic premium loan, the short version of that is an APL. So these are options that exist with whole life insurance policies that are great options in the event that you do not want to fund a policy anymore, or if life happens and you can't fund a policy anymore. Maybe it's permanent, maybe it's temporary. It's good to have awareness on these options. These are options that we've exercised across the board for different individuals. It always depends on one's situation and exactly how they want to fund a policy. There's times people approach a whole life insurance policy, they want to fund a high dollar amount, but for a very, very short period of time. And we might look at a combination of a premium offset and then a reduced paid up option and an automatic premium loan. Maybe your premium comes due, but you can't pay it right now, but you know you will be able to in a few months. This can be a great option to be aware of. So let's provide some information as to exactly what they are, and then we will look at some examples here. So automatic premium loan, which we'll use the term APL. You'll see this terminology used by a lot of life insurance companies. What I'll add about this is when you first apply for a whole life insurance policy, there is a box to check off, would you like to include an APL with your policy? And what that means is in the event that the premium comes due and you miss a payment for whatever reason, in order to prevent the policy from lapsing, the policy will take a loan against itself to cover the premium. If that box is not checked, that will not automatically happen. So if you took out a policy and this was not checked off on the original application, does that mean that you can never have it? No, you can get it. You just have to fill out a form attaching this or stating that you would like the automatic premium loan option associated with your policy. But when is it used? So the example we just described, that's the most common situation where this is used in APL, which is if you have a premium, it's due and it is missed for whatever reason. Oh man, I didn't get the notices. What's going to happen? I've got a missed payment. If you had or have sufficient cash value in the policy, what happens here is the policy will take a loan to cover the base premium for you. Now, if your policy is a number of years old, what will happen in a situation like this is, let's say you're in year 5 or year 10 of the policy and your base premium is $10,000. Will that $10,000 base premium show up in cash value? If you're 5 or 10 years in, yes, or the majority of it will. So if you have cash value, let's pretend for a second that your cash value is $100,000. We want to exercise an APL because we can't pay it. So we exercise, or it automatically happens, an APL for $10,000. What will happen, the best way I can explain this, is the day that that APL transaction occurs, your cash value balance drops to $90,000 because a loan was taken against the policy. However, that $10,000 loan then pays the premium, which because we're in the policy for a number of years, that $10,000 premium is applied to cash value. So what that will do is bring your cash value back up to $100,000. Now, it could be a little bit more, could be a little bit less. We have to account for the loan interest and then also the dividends that are being applied to the policy, if dividends are being applied to it. And we can forecast this. We can look at an illustration and see the impact through an in-force illustration, see the impact based on the non-guaranteed values and also the guaranteed values. But where we've seen it used is in a case like this, if, hey, I can't pay it, I can have the policy pay for itself through a loan. And where it's been really nice is working with real estate investors or individuals where their cash flow fluctuates a lot, and perhaps they took out a policy with MassMutual. Where MassMutual, I can easily make payment adjustments one time per year. Perhaps one took out a MassMutual policy thinking the one time per year payment adjustment would be no problem, or hey, they were comfortable with it, they wanted Mass because they like the company size and such, but then they ran into a hard time and they could not make the premium payment on that due date. So what you could do is elect to have a loan cover the premium for you. So remember a case several years ago, individual was funding a policy at $150,000 per year for several years. And I believe it was either the third or fourth policy year, let's call it the fourth year in this example, that he had his $150,000 payment come due. This was a combination of base premium and PUA dollars. And the date that it was due, the policy has a July date. He couldn't come up with the $150K. Now he would have it in a few months. His money was just tied up. And if he really had to get it, he could liquidate some things and get the money, but it didn't make sense. Now he had plenty of cash value. It was right around 400 grand or a little bit more. So what we had done is in the fourth year is exercised an automatic premium loan for the full 150. And then what he did later was just repay the loan. Because what happens in a case like that? Well, once the loan is repaid, the cash value and death benefit are restored to what they would have been as if he would have made that payment in the first place. So he did it in 1 year. You could have a case where perhaps you go through a dry period where you're really having a hard time making payments. So let's say for 5 years, you APL whatever your premium is, which results in a loan balance. Loans will be taken each year for a period of 5 years. But then after 5 years, you say, I'm going to repay the loan plus the interest that has occurred. I do always want to account for that. And we would forecast this in advance with anyone so you could see the exact interest that accrues, the exact interest you're paying to the insurance company, then the cash value restored, and see from a cost-benefit analysis, doesn't make sense to actually do this. But when I repay it, what's happened is everything's restored from a policy performance standpoint to what it would have been as if I had been making those payments the whole time and not taking loans to fund the policy. Now I can physically take a loan against my policy, have it sent to my bank account, and then send the money to the insurance company. I can do it that way as well. The automatic premium loan option does it for me. So there's an added convenience there. It also protects me in the event that I miss the payment because life happens, I'm stressed out, I just forgot. You ever forget things like that? I forgot something to go pick up my car this morning. I went for a run this morning, and yesterday evening, my wife came and picked me up from the office because they're going to run down to the office, then drive home. And I went for a run at my house. Didn't even notice my car wasn't in the driveway. And afterwards, I'm like, oh, Tara, I'm sorry, I forgot to get my car. So she had to drive me down, which was kind enough as she always is to do that. But my point is, when we're dealing with a lot, sometimes we forget things. So the APL option is a nice option to be aware of in this particular case. What it does is cover my premium for me. And the thing I like a lot about it is if I repay the loan, I see everything restored to what it would have been as if I never missed those payments in the first place, or as if I were paying it. The only thing I have to account for is the loan interest. And also, to see it fully restored, just to be 100% accurate here, that would apply with a non-direct recognition policy. There won't be much difference with direct recognition. However, if you want that dollar for dollar restoration, it would have to be non-direct recognition. In fact, let me see if I can pull up a direct recognition example. I can. And this was for a friend of mine who started a policy in his 70s. And he front-loaded the policy initially. Let's take a look here. And now he's funding just the minimum. Let me make this a little bit bigger. Here we go. Beautiful. So what we've got is his present cash value balance, $941,000. And the options we're looking at here. All right, so what we've got here, the options that is his policy. And we've got his premium and PUA payments. Let me just straighten that out so the verbiage isn't confusing. So the option on the left assumes what things look like if he continues to make the payment, and this is just the minimum, at $26,000 per year. He's got this much cash value right out of the gates because he's been stuffing the policy. His MEC limit's $220,000 and change, and for a couple of years he had funded right up to the MEC limit. Or a few years, I should say. So he's at $941 right now. Death benefit at $2.4 million. Here we go. If he just continues to pay the premium out of pocket, cut the term rider after year 7, cash value continues to grow. Now, what if he says, hey, right now, I've got other plans with my money. I want to invest them in some high-performing dividend stocks, right? Which is actually what he wanted to do. So what he could do here, we showed this as an option, is look at 0 out of pocket, but he still wants to see, hey, I might want to pay the premium. So he said, well, you could have a loan pay the premium and then pay that loan later, and the policy will function as if you were paying the premium. The only thing you have to be aware of is the loan interest. That's the true cost in this example. All right, show me an option, or show me that option. So we've got the $26,000 loan coming out. That's the loan to pay the scheduled premium amount. So his out of pocket is 0. However, this premium is being paid each year technically. So the $26,000 loan comes out. Now the loan balance here is $27,560 because we've got the loan interest of $1,560 here. That annual loan, the automatic premium loan, will cover the premium and whatever the loan interest is. So in this example, we did it through the 10th policy year, which brings the loan balance up to $192 and change because each year it's the $26,000 loan. And then if he repays it, what happens? There's my cash value. Let's compare that to year 11 over here. What do you notice? Not much difference, just about restored. Plus $2,000 more over here. And the only reason why is because this is an old Guardian policy actually, where the fixed loan rate is at 6%. So what they do is apply a 6% dividend interest rate to the outstanding loan amount, where the standard dividend is 5.65%. So there's a slight positive spread, which is why I see a little bit more. But this was an actual case study where we looked at the automatic premium loan to fund the policy, and then if he pays it back later, he's back to where he would have been as if he were paying the premium all the way through, with the exception, of course, the added loan interest. That is the cost to execute a strategy like this. And it doesn't make sense to everyone. We just want to tally up the interest and ask ourselves the question, am I comfortable with it or not comfortable with it? So it is a good option to be aware of there. Actually, we're going to look at the premium offset option and reduced paid up in the next video as we're going to compare the two side by side. Hope you enjoyed this video regarding the automatic premium loan. We'll see you in the next video. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.